Hi, welcome. What I want to do today is I want to go over a simple business. It's actually a lecture that I gave very recently in class. And what I want to do is I want to go over the same fact scenario. So if you missed it or you had questions about the particular lecture, that you could watch this video and get reacquainted with what we went over. Sometimes seeing something a second time is, or a third time is actually it can be of help. So what it was is that to give a little bit of background, we decided in class what we're going to do is we were going to form a small mobile dog grooming business. So we're going to go out and buy a van, we're going to buy some equipment, then we're going to go around and do grooming for dogs. And then that was the business, that was our business model. So the first thing that happened is the owner of the business would go to the bank and he or she would actually write a check from their own personal checking account to the bank in the business's name. So if it was David Perone who was starting the business, he was the business owner, David Perone would take a check from his wallet and write a check to the new dog grooming business. And the name of the business that we actually decided on was Durango Dave's Dog Grooming. Since it was such a long name, we just called it Dddg. So it was the name of our business. So you'd write a check out for $5,000, and that would be our first accounting transaction that we would have to account for. So what we're going to do is we're going to do the general journal entries that would happen during the period. And then what we're going to do is we're going to then create the financial statements for this small little business. So what we decided is that the business would start on 9/7/16, September 7th. And that was the day that Dave Perone walked into the bank. And the journal entry for that would have been a debit to the cash account for $5,000 and a credit to the capital account. In this case, we're going to call the D. Perone capital account for the same amount, for the $5,000. From a graphical representation, what we're going to do is we're going to do the T accounts, and the T accounts will show what's going on in a particular account. And it'll be helpful when we're coming and creating the financial statements. So in the cash account, there's a T account. The left side of the account is called the debit side. The right side of the account is called the credit side. And we have a $5,000 debit. This $5,000 debit's represented here. And then in the D. Perone capital account, we are also going to have a $5,000 credit. And it's very important that the debits equal the credits. So next thing that we did is we decided we need to actually buy the van so that we could have a place to put our equipment and do our work. So we go out and we find a Ford van. The MSRP, the manufacturer suggested retail price on the Ford van was around $48,000. We negotiated it down to $40,000. And what we decided to do is we would put $1,000 down on it, and then we would finance the other $39,000. So that's what we did. So we drove away from the Ford dealership with a van that we didn't have before. So obviously assets went up by the value, the $40,000, and cash went down for the $1,000 we wrote the check. And then our liabilities increased by $39,000 because now we have a note that we didn't have this note before. So I think we said that also happened on 9/7/16. So what we're going to do is we're going to debit an asset account. In this particular case, we're going to call the asset account vehicle or vehicles. And we're going to debit for the amount that we negotiated the price for, that we actually bought it for, which is the $40,000. So we're going to debit the asset account for that. We're going to credit cash for the amount that we wrote the check. So it's very important. Whenever you write a check, you credit cash. And so we're going to credit cash for $1,000. And if you can see, we have $40,000 worth of debits, only $1,000 worth of credits. So of course we need another $39,000 worth of credits to make this work. And the account that we are going to credit is notes payable. So that's the account that we're going to credit. From the T account point of view, we're going to have $1,000 worth of credits on the cash account, and then the notes payable, or NP for short, account is going to be credited for $39,000. There's your $40,000 worth of credits, and then the vehicles account is going to be debited for $40,000. All right. Next thing what we did is we went and we needed some clippers, so we decided we were going to buy some clippers at the store. We walk into the store, we write a check for $120 for those clippers. So if you write a check, I would always do the cash, or I always recommend students to do the cash side of the transaction first. If you write a check, you credit cash. If you credit cash for $120,000 or $120, you would debit some account for $120, and the account that we are going to debit is going to be the equipment account. And equipment is an example of an asset. We could have just as easily called it the clippers account, but some sort of asset account. So I'm going to just call it the equipment account. Let's say we do that on the 7th of September as well. Next thing that we did is we figured out we needed to do some advertising, so we went and got a big stack of flyers. The flyers cost us $200 at Office Depot, and we wrote a check to Office Depot for those flyers. So again, write a check for $200, credit cash for $200, and if you credit something for $200, you're going to have to debit something for $200. And the account that we're going to debit in this particular case is advertising expense. And that also happened on 9/7/16. Students often, they don't like T accounts, and for exactly the reason that just happened, the journal entry that I did before, I forgot to record the T account, right? So I want to go back and credit the cash for $120 and debit equipment for the $120. And then as far as the advertising expense, I'm going to create an account called Ad Expense, and I'm going to debit ad expense for $200, and I'm going to credit cash for $200 there. The next thing that we went out and did is we went out and we clipped a dog. We actually did some work. So the dog was a larger dog, and we charged $75 for doing the dog. So we did all the work. Owner comes, says, great job on doing the dog. They ask how much. We said it's $75. They give us $75. And they either give us a check, or they give us cash or a credit card. It doesn't matter how they pay. Cash, check, credit card, all the same, if they pay with their Visa card and so forth. So what we're going to treat it as cash. So we received $75 in cash. So whenever you receive cash, we debit cash for $75. And if you debit something for $75, you got to credit something for $75. And so the account that we would debit is a income account. And we're going to call that income account service revenue. Okay, this is service revenue. And let's say we do that also on 9/16, so or 9/7's busy day. Next thing happens, we have another customer. This time it's a little smaller dog. This is a $50 job. We do a great job on the dog. The owner comes to pick up their dog. And in this particular case, the owner goes, oh, uh-oh, forgot my wallet. And I'll just have to pay you tomorrow or next day or whenever I get around to paying you. So not a problem. Yeah, just pay us when you come back. I'm glad you like the work that we did on the dog. So obviously we've done $50 worth of work. We didn't receive cash, so we can't debit the cash account. But what we did receive is we received a promise to pay. So in business terms, that's called a receivable, and so that's an accounts receivable, AR for short. And so accounts receivable, and we're going to debit accounts receivable for $50, and we are going to credit cash for, not cash, no, my goodness, not cash, credit service revenue for $50. And again, look what I did is I forgot to record both the journal entry before as well as forgot to record the journal entry before of $75 received and service revenue of $75. And now we have a $50 service revenue and an accounts receivable of $50. All right. Next transaction, what we did is we decided that we need to purchase a table. We've been doing these dog trimmings basically without a table, and so it would be handy to have a table. So we buy a table. We find a table. It's about $500. We don't want to spend the $500 cash. We're trying to kind of slow down the cash payments going out. So we're a new business. So what we do is we negotiate with the vendor of the table and say, hey, can we pay you in 30 days? And the vendor agrees. So here we have a table that we didn't have before, so our assets are going up. So we're going to debit some sort of asset account. And then we're not writing a check, so we can't credit cash, but we do owe money. So we're going to have to increase or credit a liability account. And so that journal entry, let's just put that on a different day, 9/8. So that journal entry is going to be a debit to, let's put that table also into equipment. And that was for $500. So we're debiting the equipment account for $500. And if you debit an account for $500, you got to credit an account for $500. And the account that we are going to credit is going to be accounts payable. So accounts payable. That's an example of a liability. Now we did a notes payable before, and the difference between a notes payable and accounts payable is a notes payable you actually signed a promissory note to actually pay back the amount. Here, $500, probably we're not going to have to sign any note, promissory note. It's just going to be, based on our goodwill or a credit. The next thing that we did, so I recorded, I just want to make sure I recorded, I didn't record the accounts payable. Accounts payable has a credit balance of now $500. Again, the T accounts are not required, but it does help you show what's going on within the account. And it becomes very, very helpful when it comes to creating the financial statements. The next thing that happened is, remember that dog that we did for $50, but the owner didn't have the cash? Well, the owner came in and paid us the $50 in cash. So let's say that happened on 9/10/16. The owner comes in, pays the cash. So we receive cash, and if we receive cash, we're going to debit cash for $50. And if you debit something for $50, you're going to have to credit something for $50, and the account that we are going to credit is accounts receivable. So if you go back over here to our accounts receivable, remember this was for the $50. Now the person comes in, pays the $50. So we're crediting the accounts receivable. Obviously, if you have $50 worth of debits, $50 worth of credits, the balance in the accounts receivable account is zero, which makes sense. They don't owe us the money anymore because they paid us the money. So there's the $50 credit. The $50 debit is going to be in the cash account because we received $50 in cash. The last transaction that we did, we'll just say that happened on 9/11. And what we did is we decided we needed to withdraw, $1,000 to pay our own mortgage. So the owner is pulling money out of the account themselves. All right. So when an owner pulls money out, that's called a draw. And you're withdrawing equity from the business. And so the owner will write a check. Whenever you write a check, regardless of who the check goes to, we credit cash. And so we're going to credit cash for $1,000 because that's how much the check was for. And if you credit something for 1,000, you got to debit something for 1,000, and the account that we are going to debit is the drawing account. So that is the account that we are going to debit. So we're going to credit cash up here in our T accounts for $1,000, and we are going to debit the drawing account for $1,000. All right, so what we'll do next is we will calculate what all the balances are within the T accounts, and then we will create the financial statements, the income statement, statement of owner's equity, and balance sheet. So what I've done is I've erased the general journal entries over on this side, but I've kept the T accounts over here, and I've tabulated the individual balances. So for example, the cash balance, when you take the debits and you look at the difference between the debits and the credits, the difference between them is a $2,805 debit balance, which is what you would expect with an asset account. The normal balance of an asset account is a debit balance. Same thing with equipment. Equipment has a $620 debit balance. Service revenue over here has a $125 credit balance. Again, service revenue is an example of an income account, and you would expect it to have a credit balance. So now what I'm going to do is I'm going to create the financial statements. The first financial statement that we're going to create is the income statement. So income statement has the name of the company or the name of the business. Dddg stands for Durango Dave's Dog Grooming. The name of the statement, income statement, and then the range of time. And so this is for the month of September of 2016. So for the month of September 2016. Okay, so this includes all of the days in September. After you have your title, the next thing that goes on income statement is going to be our income account. The only income account that we have is service revenue. Service revenue, and the service revenue balance is $125. That's doing the two dogs, the $75 big dog and the $50 little dog. So we've got $125 of service revenue. After you're finished with all your income accounts, which is usually going to be one in a service business, the next thing that you do is you subtract out all of your expense accounts. And expenses are subtracted from your biggest expense down to your smallest expense. Now, looking over our T accounts, the only expense that we actually have is ad expense. So we're going to subtract the expenses, and that's just the ad expense. So ad expense is the only expense that we have, and that's $200. Again, if you had expenses, the biggest expense is first, second biggest is next, and so on and so on. Once we take our income accounts minus our expense accounts, you're left with either net income if it's a positive number, or a net loss, which is what it is in this particular case, of $75 if you have more expenses than you have net income. Next financial statement that we're going to create is the statement of owner's equity. Again, starts with the title. It's the statement of owner's equity, and it also has the same date range, and this is for the month ending 9/30/16. So the beginning balance, because this is a new business, our beginning owner's equity is going to be 0, because remember this that would have been the beginning as of September 1st. Then what happened is we have to add the investment that happened during the month, and that was $5,000 of investment. That was that $5,000 check that we went into the bank and wrote. Then we're going to subtract out less net loss, which is coming from the income statement is going there. So we're going to subtract out the net loss of $75. Obviously, if we had a net income, then we would add the net income to the statement of owner's equity. The last thing that we need to do is we need to subtract out less the drawing, right? Less the drawing. Now notice the drawing did not go on the income statement because the drawing is not an expense. Drawing goes on the owner's equity statement. So this $1,000 drawing balance goes over here onto the statement of owner's equity. And so when you take $5,000 minus $75 minus $1,000 is actually in brackets, you get what, $3,925 in ending owner's equity. So once we have our owner's equity statement finished, then we can go to our balance sheet. Balance sheet starts off with the title. So name of the business, balance sheet, and this is an as of the last day of the period. In this particular case, it's September 30th. So this is not the amount of cash that we had on September 1st. It's not the amount of cash we had on the 5th. It's the amount of cash we had as of September 30th. And if these were the only transactions that happened in the month of September, then this would be what's going on. So assets are on one side, liabilities and owner's equity is on the other. That's the accounting equation. Assets equals liabilities plus owner's equity. So it's exactly the same as the accounting equation. Owner's equity, what I always like to do is put owner's equity because you know what the owner's equity number, it's the $3,925 number that came from the statement of owner's equity here. Then I like to go over to my asset side. And so the assets that we have, your most favorite asset, which is always first because assets are listed not from biggest to smallest, but assets are listed in order of liquidity. So what can be converted into cash the fastest? And of course, cash is already done because it's already been converted. Cash is always first. So cash has a balance of $2,805 in the cash account. The next account that was normally that you would put up here after cash is accounts receivable. But accounts receivable has a zero balance because that one receivable that we had, the owner of the dog came in and paid a little bit later, so we don't have any receivables. The other two assets that we have is equipment, which makes up of the clippers and the table, and the vehicle account. So we could have a kind of an argument, and there is a way of presenting it, but basically what I want you to know for right now is and I'll let you figure out what's easier to get rid of on Craigslist. And I think that it's probably easier to get rid of a table and some clippers on Craigslist, sell it. I could probably convert that to cash faster than I could convert a $40,000 vehicle. You know, we could have an argument about that. It doesn't really make too much difference. So equipment, I'm going to put next at $620. After that, I'm going to put vehicles up here at $40,000. And again, we're going to get into more of the, how it's done, how it's reported. This is very, very high level type, very simple business. We're going to get into more of the reporting issues before. So don't, this video should be one of the first videos that you watch during the semester, not one of the last ones, because we're going to get into a little bit more of the detailed reporting requirements. So when we add up $2,805 and $620 and $40,000, it's $43,425 or something close to that. We'll keep that on my total assets side. Total assets. Okay, are $43,425. On the liabilities, we have two liabilities. We have accounts payable and notes payable. Accounts payable or actually all the liabilities are listed in order of what you have to pay back the soonest. So think about that. The accounts payable, that $500 for the table, was going to have to be paid back within 30 days. The 39,000 is probably going to have to be paid over what, 4 years, 5 years, 6 years, whatever the length of the loan is. So typically you put accounts payable first, and that's normal. And then we're going to put notes payable after that at $39,000. So our total liabilities are what, $39,500. So if you got $39,500 total liabilities, and you add to that the owner's equity of $3,925, you get $43,425. And this number here, the number on the right side of the balance sheet, equals the number that is on the left side of the balance sheet. So we're happy about that, because that's just what is supposed to happen. Now, one little caveat: just because your balance sheet balances doesn't mean you have made a mistake somewhere else in the problem. It's possible that you made a mistake in doing a journal entry, or you forgot a journal entry, and your balance sheet still will balance. But that's definitely a goal, and we feel good that it actually happens. But just because it balances doesn't mean you've done everything correctly. But obviously, if it doesn't balance, you've done something wrong. So anyway, hope that helps. I look forward to seeing you in class or on the next video.